when Wall Street opens. Dow futures still up 8 points at the moment, so pointing to a slightly firmer open, and we will of course be looking at what to expect from that US non-farm payrolls. Well, gold prices tumbled for a fourth straight session last night on disappointment over a lack of stimulus measures from the ECB and the US Fed Reserve. With demand lagging and major gold producers looking to reduce output, is now the time for investors to exit the precious metal? Sky News business reporter Nigel Freitas caught up with Brocque to find out.
Well, gold has been a safe haven for traders for quite some time, but with the price dropping recently, some investors are now wondering if it's time to exit from this particular commodity. Let's put that question now to Brocque from the Brocque Capital, who joins me here at the banks of the Yarra in Melbourne. Brett, we've seen gold hit those highs last year, especially in September. The price now falling somewhat. What do you think? Is it time to go for those exit doors?
Well, I think the important thing is gold hit its high at 1900 last year. If we have a look at the US dollar index then, the US dollar index nearly broke 72. Now the US dollar index now has rallied to 83, so there's a strengthening in the US dollar. Now the question is, why is that happening? Well, people are exiting the Europe and the Eurozone. They're worried about markets right now, so their flight to safety in the short term is the US dollar. So gold competes as a competitor against currency. So when the US dollar rises, gold falls. When the US dollar goes down, gold goes up. The other big thing is there's massive deleveraging going on right now. So people are covering their short positions, meaning that they've borrowed money on margin and they're getting called. So what they normally do is sell assets that are doing very well to cover the short positions on the assets that aren't doing very well. So when you combine all that, that's where gold and silver are consolidating right now, around that $1,600 mark for gold and around $27 to $30 for silver. But I'll stick my neck out on the line here and I'll say that I think we've seen a floor in gold at around 1,500, purely because of Chinese buying from both central banks and their citizens. On top of that, you've got a Japanese pension fund for the first time in history that have just bought gold. And then you turn around and look at the central banks around the world, from India and Russia, that are adding to their positions. So I think the fundamentals for gold and silver couldn't be stronger, and investors need to understand that the role of gold is a competitor against currencies.
I'll come back to where you think gold's going to go, and China as well. But as our audience would know, we did see last night gold recording some steep declines. Many people say that's because of the lack of progress from the ECB and also the US Fed. Were traders expecting more from those meetings that were held overnight?
I think it's just a matter of time before the ECB kicks in with more stimulus and more money printing, and I think it's just a matter of time. I'm expecting September, October, November this year that there's a good chance you're going to see QE3. Now, when you see that, we're off to the races again. The biggest thing I would say is a nation can't print their way to wealth. If you think we can, then Zimbabwe should be the richest country on the planet. So what we have to understand is that the price of gold, it's really gold's price relative to currencies around the world and how much central banks keep printing. So the alternative to a currency is holding a portion of your wealth in physical metal.
You talked a bit about China there, and I'm sure that our audience sitting at home would hear mixed signals coming out of China. Some people say a contraction is on the way, others say no, growth is still going to continue. We heard recently also the mining boom may be over in a couple of years. What's your take on Australia's position in relation to China and how that might affect commodity prices as well?
I think we first need to go back in history to understand where China is and how China developed. It's the trade deficit of the US since the rules of money changed in 1971, when Nixon took the world off the gold standard, where the trade deficit in the US have gotten so big that that's exported inflation around the world. That's what created China from a third world country into the China that we know today. So with that massive stimulus going on, and don't forget, China printed more stimulus as a percentage of their GDP than any other country in the GFC. The problem with all this is they've had what you call a misallocation of capital. All that wealth has flowed over into infrastructure that they really didn't need, such as cities, properties that are vacant. You know, the word is that there's 64 million vacant apartments in China right now. So where do we get all those raw materials from? We got those from Australia. We got cushioned in the GFC. I don't think that will be the case. I definitely see that. One thing I've known for sure is that since 1971 we've gone from economics to bubblenomics. So America, with running large trade deficits, have put bubbles across the world in asset prices, which have all popped. We saw that happen in Japan in 1990. We saw the Asian crisis in 97. So it's America running trade deficits where they've gone from a country of producers and savers to consumers and spenders, and they've exported inflation around the world, which has created asset price bubbles.
Now, turning back to gold itself, we've talked about China. What about India? They're the biggest purchaser of gold. Reports there that supply is really slowing down and poised to contract, some say by up to 30% this year alone. What impact is that having on gold prices?
I think when you look at gold, you've got to look at, or any market for that matter, when the prices drop, you see that there's massive selling pressure going on. Now, we have to understand that there's the paper market for gold and the physical market for gold. They're two very different things. Unfortunately, at the moment, it's the paper market that dictates the price of the physical market. So when we see a lot of selling going on, we first have to see where that's coming from. So I know a lot of that is computer-based selling going on. Now, coming back to India, when you look at their central banks and the central banks around the rest of the world, they're net buyers of it. And for the first time in the last 20 years, central banks around the world are becoming net buyers of physical metal. And that's the most important thing to understand.
Now for a look at the tech, media and telco stocks.